Everyone loves the idea of having $1 million. It feels like the point where life gets easier, where money stops being a daily worry. But the truth is simple. $1 million only matters if it sends you enough income every month to actually live. If it doesn't, you're not set for life at all. That million disappears. And if you're using it to pay expenses, it can be gone in less than 15 years before you're broke again. John doesn't want that. So what he wants to know is if he invested $1 million into today's most popular ETFs, would the monthly checks be enough to support his life, or would he still feel the same budget pressure he feels today? In this video, John's going to put his $1 million into 6 different ETFs, starting with the safest and working his way toward the highest paying options. For each one, he wants to see 2 things. First, what the ETF actually is, how it works, why it pays what it pays, and what makes it stable or risky. And second, how much income could realistically be put in his pocket every month. And by the end, you'll see the ETF that could potentially pay John over $10,000 a month. John begins with the safest ETF in America, Vanguard S&P 500 ETF, or VOO for short. This is where most people start when they think about safe investing. It's a simple fund that tracks the S&P 500, which means it owns pieces of America's 500 biggest companies. These are the brands John uses every day without thinking about it, like Apple, Microsoft, Amazon, Coca-Cola, Costco. When people think about owning the market, this is usually what they mean. What makes VOO work is how little it tries to be clever. It doesn't attempt to pick winners or predict trends. It just follows the biggest companies in the country and lets them do what they've always done over long stretches of time: grow, adapt, and survive decades of economic ups and downs. And because it's spread across hundreds of companies, no single business can sink the whole fund. That stability is exactly why so many investors trust it. But stability comes with a trade-off. These giant companies reinvest most of their profits back into themselves instead of paying large dividends. They're focused on expanding their businesses, not handing out big income checks. So even though VOO feels incredibly safe, it isn't built to generate meaningful cash flow for someone who wants to live on their investments today. That reality hits John fast. The fund has a dividend yield of just 1.12%, meaning John's $1 million investment in this ETF would send him about $11,200 a year, which breaks down to roughly $933 each month. And when he imagines living on that amount, well, the picture tightens immediately. $900 barely covers groceries, utilities, and a phone bill. Rent doesn't even fit. Insurance doesn't fit. Anything fun definitely doesn't fit. His life becomes a checklist of what he can't do rather than what he can. John tries to justify it. VOO has a strong long-term track record. It's lifted countless investors over decades. But long-term growth doesn't pay short-term bills. And John's trying to map out the next 30 years. He's trying to understand what $1 million can do for him right now in a world where expenses come monthly and life doesn't wait. With VOO, the answer becomes painfully clear. It's safe, it's reliable, but it doesn't buy the kind of life John imagined when he pictured living off his $1 million investment. He needs more income without jumping into anything reckless. That's when he turns to Schwab U.S. Dividend Equity ETF, or SCHD for short, hoping it can offer both stability and a paycheck he can actually feel. Quick shout out to the sponsor of this video, Moomoo. If you've been investing through your bank or one of those bare-bones apps, this might be a good upgrade for you. Moomoo is a free platform that gives you real-time market data, advanced tools, and zero-commission trades all in one clean, easy-to-use app. New users right now can get up to $1,000 in NVIDIA stock just for opening an account and making a qualified deposit. The more you deposit, the more NVIDIA stock you earn. It starts at $20 for $100 and goes all the way up to $1,000 in stock if you deposit $50,000. That's on top of their usual promos. You still get 8.1% APY on uninvested cash, and yes, that cash is FDIC insured up to $1 million. You'll also get access to Morningstar research, analyst ratings, and premium news sources like the Wall Street Journal and Bloomberg. So if you want to check it out, the link is in the description and pinned comment. Even if you're just curious, the promos alone make it worth a look. So thanks again to Mumu for supporting the channel. Let's get back to John's income ladder and his second ETF, SCHD. So SCHD is the ETF people turn to when they want income that actually feels real without stepping into anything exotic. Instead of focusing on the biggest companies, as VOO does, SCHD looks for businesses with a history of paying reliable dividends and the financial strength to keep paying those dividends. It's built around companies that don't just make money, but consistently share their profits with shareholders. What makes SCHD work is the way it selects those companies. It filters for strong balance sheets, steady cash flow, and a track record of growing dividends over time. Even though it's still a basket of large U.S. companies, it tilts towards businesses that put cash in investors' pockets rather than reinvesting everything back into expansion. It's stable, with a little more focus on income. And that focus is exactly why the yield jumps. Instead of owning fast-growing giants that reinvest their profits, SCHD owns companies that prioritize returning money to shareholders. It doesn't promise anything dramatic, but it does offer something VOO can't: a dividend that feels usable, with a dividend yield of around 3.72%. That difference becomes real for John. With SCHD's 3.72% yield, his $1 million investment pays him around $37,200 a year, or roughly $3,100 each month. With that, John's not rationing his life anymore. $3,000 isn't a fortune, but it covers rent in a modest apartment, groceries, health insurance, and the little things that make life feel normal. He can pick up a hobby, meet a friend for dinner, or take a weekend trip without feeling guilty. More importantly, John stops feeling like every purchase is a threat to his stability. He still budgets carefully, but the constant stress begins to fade. SCHD doesn't make him wealthy, but it gives him a lifestyle built on predictable comfort rather than daily calculation. The growth side is another bonus here. While SCHD pays a solid dividend, it has also grown steadily over the years, not as fast as VOO during roaring markets, but enough to help his money keep up with time. It's the first ETF where John feels like he isn't forced to choose between income today and growth tomorrow. But comfort has a ceiling. $3,000 a month is livable, but not liberating, and John can't help wondering, what if he moves one step higher into true high-dividend territory? What if he wants income that actually expands his life instead of just supporting it? That's when he looks at SPYD, or the State Street SPDR Portfolio S&P 500 High Dividend ETF. SPYD is where John first steps into true high-dividend territory. Unlike SCHD, which carefully selects financially strong companies with steady dividend histories, SPYD takes a more direct approach. It starts with the S&P 500, finds the 80 companies paying the highest dividends, and builds an equal-weighted portfolio out of them. There's no storytelling, no complicated filtering, just the highest-yielding stocks among some of America's largest companies. That simplicity shapes how SPYD behaves. Because it's equal-weighted, smaller companies in the index get the same influence as giants like Pepsi or Verizon. This means SPYD leans into parts of the market that tend to pay bigger dividends, like energy, utilities, financials, and real estate. These sectors can be dependable, but they're also more sensitive to economic cycles. When times are good, they pay well. When things slow down, they wobble more than the broader market. And that's exactly why the yield is higher here. SPYD isn't chasing growth, it's collecting income. It owns companies that return more cash to investors today, even if they don't grow as aggressively tomorrow. For someone living off their investments, that trade-off can feel worth it. When John runs the numbers, the difference is clear. SPYD has a 4.49% yield, which means a $1 million investment produces about $44,900 a year, or roughly $3,742 a month. It's not a dramatic leap from SCHD, but it's enough to make his life noticeably easier. With that extra $600 to $650, John has room to make choices. At nearly $3,800 a month, John can upgrade to a slightly nicer apartment, maybe in a neighborhood where he feels safer walking home at night. He can go out with friends without checking his bank balance 5 times beforehand. Hobbies feel manageable instead of indulgent. And instead of saving tiny amounts, he can finally build a cushion that grows a little each month. So this is a great start, a solid monthly return from a solid ETF. But as we climb higher on the ladder of risk and reward, things get a lot more interesting. In fact, some investments pay even more. And by the end, I'll show you the one ETF that gives John over $10,000 a year in dividends right away. Back to SPYD. Emotionally, the constant pressure that defined his VOO experience is gone with SPYD's close to $3,800 monthly income. The cautious comfort of SCHD has expanded into something else: breathing room. Life feels a little easier, less constrained, and more his own. But as John examines SPYD's track record, he gets curious. The income is strong, but the growth has been inconsistent. Some years it shines, others it stumbles. And that leads him to the next question. What if he wants income that feels reliable and truly steady month after month without depending so heavily on market cycles? That's when John discovers the JP Morgan Equity Premium Income ETF. This is the point where John feels like he's stepping into a completely different type of investment. Up to now, every ETF he's tried has been built around traditional stocks, some focused on growth, some focused on dividends. But JEPI combines stocks with something very different: option premiums. And the result is an income stream that finally feels substantial. At its core, JEPI invests in large U.S. companies with relatively low volatility. These aren't the loud, fast-moving tech names. They're steady businesses: healthcare, insurance, consumer staples, industrials, companies that don't jump around much but continue producing reliable cash flow. That's the base layer. The second layer is where the income really comes from. JEPI sells covered call options, which is a simple trade in practice. It gives up a portion of future upside in exchange for cash today. Think of it like renting out the future potential of a stock. If the stock price soars past a certain amount, JEPI doesn't capture all that growth, but it still keeps the premium the moment the option is sold. And because it does this continually, those premiums add up to real monthly income. And if the stock price drops, JEPI still keeps the premium it collected up front. The covered call doesn't protect it from the stock falling, but the premium softens that hit a little. It's like getting paid to hold the position even during a dip. That structure is why JEPI's yield is so much higher than traditional dividend ETFs, hovering around 7.47%. It doesn't have to wait for companies to distribute profits. It can generate income on demand through option premiums. It trades a bit of long-term upside for consistent cash flow now, exactly what someone like John needs if he wants investing to feel like a paycheck instead of a long-term bet. And when John looks at the numbers, his eyes widen. With a yield of 7.47%, his $1 million investment pays him about $74,700 a year, or roughly $6,225 each month. That changes everything. $6,000 isn't just comfortable, it's transformative. At this level, John can move into a place he genuinely enjoys living in. Not the cheapest option, not the compromise, but somewhere that feels like home. Travel stops being an annual event and becomes something he can plan a few times a year. He can pick up hobbies without the guilt that used to follow every purchase. Health insurance becomes manageable. Car repairs, yes, are still inconvenient, but they're never scary. And for the first time, he can save meaningful amounts every month without feeling squeezed. Emotionally, this is the turning point. With JEPI, John stops thinking about how to survive each month and starts thinking about what he wants his life to actually look like. The income feels steady, predictable, almost like a salary someone wired into his account. But as steady as it feels, JEPI still leaves a question lingering. If this much income is possible from a low volatility portfolio, what happens when you apply the same strategy to something more explosive, like technology? So he started looking into JEPQ, short for JP Morgan Nasdaq Equity Premium Income ETF. This is the ETF that makes John feel like he's stepping onto a faster-moving track. It comes from the same family as JEPI and uses a similar covered call strategy, but the foundation underneath it is completely different. Instead of focusing on slow, steady companies, JEPQ leans into the tech-heavy world of Nasdaq, businesses built around innovation, software, data, and digital infrastructure. These companies move quickly, sometimes wildly, and that movement is exactly what fuels JEPQ's higher income. At its core, JEPQ owns a diversified basket of technology and growth-oriented stocks. Names like Apple, Microsoft, Nvidia, and others shape the backbone of its portfolio. These companies don't behave like the low-volatility stocks inside JEPI. They surge during strong markets and pull back sharply during weaker ones. That volatility might scare some investors, but for a covered call strategy, it actually opens the door to more income. That's because JEPQ earns its extra yield through the same mechanism as JEPI, selling call options. But selling calls on tech stocks is a very different experience from selling them on slow-moving value companies. Tech names swing harder, and bigger price swings mean higher premiums. So even though JEPQ still gives up some potential upside when markets really take off, it earns more from selling those options up front. That steady stream of premium income is what boosts JEPQ's yield beyond JEPI's, standing currently around 9.47%. And when John runs the numbers, the difference is immediately visible. With a yield of 9.47%, his $1 million investment generates roughly $94,700 a year, about $7,892 every month. That's almost $8,000 a month. For the first time, John feels like his income isn't just supporting his life, it's expanding it. $8,000 a month opens doors that used to feel out of reach. At this level, his living situation improves dramatically. He can choose a home that feels inspiring instead of simply affordable. Travel becomes a regular part of his life, not a reward he has to save for all year. He can upgrade his insurance, invest in healthier routines, try new creative hobbies, or even support family if he wants to. And he can do it all without feeling like he's pushing his budget to the edge. Emotionally, JEPQ delivers something new. JEPI gave John stability. JEPQ gives him a sense of momentum, like his life finally has room to stretch. But with that feeling comes a small shadow of doubt. Tech-driven income depends on volatility staying high enough to generate those premiums. And while the upside feels incredible now, John knows tech doesn't move in straight lines. Still, he wonders, if this much income is possible from a tech-focused covered call fund, what happens when he steps into the one ETF famous for prioritizing income above everything else? He keeps hearing about one ETF at the top of the yield ladder, QYLD, the Global X Nasdaq 100 covered call ETF, famous for its massive monthly payouts. For John, it's the final stop, the extreme end of the income spectrum. And unlike the other ETFs he's tried, QYLD isn't built around holding stocks for long-term growth. It's built around generating cash flow right now, even if that means giving up almost all of the upside along the way. This is also where QYLD separates itself from JEPI and JEPQ. Those two ETFs sell covered calls as well, but only on part of their portfolios. They still leave room for some growth, and that balance is what keeps their income steady without completely shutting the door on future gains. QYLD doesn't do that. It overwrites every position every month, which means it chooses income over upside in a much more aggressive way. QYLD owns the NASDAQ 100, which means it holds some of the biggest tech companies in the world: Apple, Nvidia, Amazon, Meta, and others. But instead of letting those companies grow naturally, QYLD immediately turns that potential upside into cash by selling covered calls on the entire portfolio. It's like agreeing every month to cap how much the portfolio can rise in exchange for a guaranteed payment today. That's why QYLD's income, with a dividend yield of 12.57%, is in a different universe compared to most ETFs. When John calculates the numbers, the jump feels unreal. With a 12.57% yield, his $1 million investment pays him about $125,700 a year, roughly $10,475 every month. $10,000 every month. At this income level, John could rent or buy almost anywhere he wants. He could live in a high-rise with a view, buy a home in most cities, or split his time between two places if he feels like it. Travel stops being something he plans, it's something he schedules in between everything else. Long trips, multiple countries, extended stays, all of it becomes normal. He can upgrade every part of his life without thinking twice. Healthier food, better healthcare, experiences that used to feel out of reach, classes, coaching, and passions he never had time or money to explore. He could fund side projects, support family, invest in ideas, or simply buy back time by outsourcing the parts of his life he doesn't want to do. And the biggest shift is psychological. At this income level, John could walk away from work, not to survive, but to live. But with that freedom comes a different kind of pressure. QYLD's income looks incredible today, yet the foundation supporting it isn't the same as the other ETFs. By selling away all of its future upside, QYLD sacrifices long-term growth. The payments are large, but the principal may stagnate or even decline over the years. The income is real, but it's built on a portfolio that isn't compounding the way traditional funds do. And that leaves John with a strange feeling. QYLD is the first ETF that gives him everything he imagined: freedom, flexibility, abundance. But it's also the first one that makes him wonder whether the comfort he gets today might cost him the stability he needs tomorrow. He has to choose which freedom matters more: the kind that feels good now, or the kind he can trust for decades. As he steps back, the pattern becomes clear. $1 million can create almost any lifestyle, but each ETF comes with its own trade-off. Some offer safety without comfort, others offer comfort without long-term security. And suddenly, John realizes this journey was never about chasing the highest yield. It was about finding income he can rely on. If you want to see which ETF could actually double John's million in just a few years, the video on the screen breaks it down.